Good morning, YouTube. Today is Tuesday, May 28th. We have a shortened week, but we start it with Tom and Anthony. Good morning, fellas.
Good morning.
Good morning.
Everyone have a good long weekend?
Yeah, man.
Yeah.
It was relaxing. Yeah, we got to memorialize the troops. I don't know if that's the right word, but thank you for your service. Look at Ryan's face that froze there.
Having internet problems this morning. It's all good. So no one became Dorothy this weekend? No tornadoes in the area?
No.
It was windy, though.
I picked up a few tree branches and leaves yesterday when I cut the grass, but no trees down.
Good.
What about down the south?
No, just some thunder and lightning down here.
Yeah, no. We're not in Tornado Alley, so they're saying we're gonna be, but I don't feel it.
I mean, we've never had so many tornado warnings, man, and ever as we have in the last month. So
I read that because of the warm El Nino winter that Western Pennsylvania has temporarily entered Tornado Alley.
Yeah, I just don't see them forming, over the hills. We're going to go back to regular science. And yes, the weather patterns might be bringing in tornado possibilities, but the science of the geography of the ground isn't going to let it happen.
It's true. Hills should help stop tornadoes.
At least break it up. Maybe they'll come down and leave, microburst type stuff, but we shouldn't be getting a twister like Oklahoma does.
Tom just turned into the weatherman real quick.
Yeah. Brought to you by AM Chatter. This is actually supposed to be the worst hurricane season in history because none of the water's cold. So
I saw that.
Weatherman Tom predicting Hurricane Katrina, and Hurricane Tom will be ripping up the Gulf Coast this summer.
Well, let's turn the page and talk about some happy stuff or some exciting stuff. And what we're going to talk about today is some mortgage tricks on how to remove mortgage insurance. Mortgage insurance as a part of your mortgage payment that no one really likes to pay. It's the biggest perk of putting 20% down on a conventional loan is you don't have mortgage insurance. But buyers and real estate agents aren't aware that there's a way you can remove mortgage insurance quickly after closing, and there's a way to never have it with less than 20% down. So we'll start out first with Anthony, the expert, in how to remove mortgage insurance if you have less than 20% down when you purchase a home.
Yeah, so that's probably one of the biggest myths besides that you need 20% down to buy a house is that you need 20% down to not have PMI. And that's not actually facts. You can actually put down the minimum down payment and buy out that mortgage insurance up front, which is part of your closing costs. So you do not have mortgage insurance. And a majority of the time, the buyout is a fraction of what you'd be paying over the time that you would have it. I did one yesterday for a pre-approval. The guy was doing 10% down. We bought it out. It cost him $2,300. If he did another 10% down, it would have cost him another $22,000. So huge savings on liquid assets. Most clients don't want to spend 20%, but they feel they have to. So if they're saving that money and buying it up front, it's definitely saving them on the liquid assets for sure.
I mean, that's a good, short, quick, sweet way to talk about it. The buyout cost is cheaper than the monthly cost, and you can just add that to your closing costs. Like Anthony said, if you don't have all the funds to put the extra 10% down to get the 20%, you can just buy it out, have that fraction, and add it to your final closing cost. So that's prior to closing. That's only on conventional loans. Can't do that on a government loan. FHA loan, you're not really able to buy out mortgage insurance. You can put a larger down payment so it goes away quicker, but you can't buy it out. But heck, I think we're still 80-90% conventional loans in this market right now. So I would believe that's most buyers.
Yeah. Yeah, most of them have that opportunity, and you could even do it with a 3% down if you want to buy it out for the whole thing. So the options are there.
Absolutely. Now, for the biggest magic trick of the show, the post-closing removal of mortgage insurance, I feel like is the least known ability that a buyer has. You know, you close, you have your mortgage payment. Your mortgage payment's going to stay the same unless your taxes and insurance go up. Shocker. Usually your taxes and insurance go up, especially these days. I think the insurance is outpacing the taxes, to be honest. I can't believe I'm saying that. But there is a way to remove it. And Tom, I think you've tried to go through this process actually.
Yeah.
So again, let's talk about after 2 years. You're in your house 2 years, right? We all know values are probably at 5, 6, 7% a year going up. How do you remove that mortgage insurance post-closing?
So what you need to do is you order a BPO or a broker priced opinion. I'll just give you a personal example of mine so you guys can hear that. I have Wells Fargo as my mortgage lender servicer. So I contacted them to try to remove my MI, and they told me I need to order appraisal through their appraisal service management company. We had that ordered. He came out and they sent the report over to them. And I was able to get my PMI removed because I was under 78% equity, not 80% or, loan to value wise. You got to have over that 20%. It has to be 22% if you don't start with the 20%. So they had to come out, appraise my house, make sure the value is there based off the current loan. And in fact, it was. So we were able to remove that MI. When doing it, we calculated how many more MI payments we were going to have before that fell off regularly. We saw what it cost, and we made sure that it was going to be the right decision to remove that MI with how much the appraisal would cost. So that was a success for us. We did that about a year ago now, and we're living MI free here over in Kennedy.
And that is the way to do it. So if you see on your closing disclosure, a lot of time, if you put 5% down and you have MI, it's going to be 11, 12, 13 years of normal amortization till that falls off. Where after 2 years, you're going to be pretty darn close with the way values are going, that you can do exactly what Tom said. Call your servicer, say if you believe you're at that 78% or lower, to say, hey, I think we have enough equity, get an appraisal done, and boom, couple of months down the road, your mortgage payment just got lower.
Yeah, no, it's a great perk. It actually worked out great in our case. I also tried to remove our escrows. I know we're not talking escrows here, over the 20% in 2 years. However, they did not let me because you have to get your original principal balance to under that percentage that they want. So they wanted me to put down like $3,000 more to remove my escrows, which wasn't going to happen.
Gotcha. That will be another episode of how to pay your own taxes and insurance if you want to post-closing as well. But real estate agents, it's a great call. I know at West Penn, we send out a lot of marketing emails letting our past buyers know they may have a chance to remove their mortgage insurance. Where again, if you purchased a home in COVID or a little bit after COVID, instead of sitting there and maybe there's a reason for a phone call, that's a pretty good reason, just to mention how to remove the mortgage insurance.
I think it's great tip.
Anth, it's good to see you back outside. I know you've been strapped inside the last couple months, so I'm excited to hear the birds chirping again.
They're chirping, buddy. They're chirping.
That's good.
So.
That's good. We've done chatter so long. We've gone through a whole 4 seasons in Pittsburgh.
We're coming up on 5, baby.
Yeah.
139 episodes, man.
Not bad. All right, let's get this shortened week kicked off. Guys, need anything? You know where to find us. And have a great rest of your week.
Thank
See you guys.
See ya.